Let me ask you a question. What is the largest tax penalty in the IRS code, and what is it for? Does anybody know? Let me tell you what the answer is. The largest tax penalty in the IRS code is 50%. That's a tax penalty, folks. 50%. And it's if you mess up your RMD, which is your required minimum distribution calculation. So if you make a mistake on that calculation, or even if your accountant makes a mistake on that calculation, you're going to be hit with a 50% penalty. An example of that would be, let's say you're supposed to take $2,000 out, and you only took out $1,000. Well, there's a shortfall there of $1,000. They're going to make you take that $1,000 out, pay your taxes on it, and then hit you with a 50% penalty, or $500, all that same year. Now, that's a lot of money to anyone. So what you need to understand is, how do we avoid that? Well, in the past, it's been really hard to figure out exactly how much money you're supposed to take out of your accounts. Nowadays, they have the Uniform Lifetime Table, which was established in 2002. Most of your accountants are well aware of this, and they can calculate things pretty good. What's going to happen is, the accountant's not going to make a mistake. You might forget to take all the necessary documents to him. So they do know what they're doing, but sometimes we can all make little mistakes, and it can really hurt us. And with this topic, this situation, with a 50% penalty, you can really get hurt. Well, what is an RMD? Well, an RMD, again, required minimum distribution. That's the amount of money that the IRS makes you take out of your qualified accounts at age 70 and a half. Remember, 59 and a half is when you can start taking your income without the 10% penalty. Well, at 70 and a half, that's when you have to start removing those dollars. Qualified dollars are like your 401ks or your IRAs. Money that you've been growing tax deferred, and you haven't had to pay any taxes on it. That's what tax deferred means. You're deferring that income. Well, what you've been deferring that income to is age 70 and a half, where you have to start taking it out. Now, you've been deferring this income your whole life. What an RMD says is kind of, it's time to pay the piper. It's time to pull that money out and pay the government its taxes. Well, what we're going to show you today is a really interesting strategy for RMDs. We're actually going to make an insurance company pay your tax bill for you. If you look at that handout we gave you, you'll see, make sure you flip to the side that has all the numbers, you're going to see where there's $100,000 put in. We assumed a 5% growth rate, and we have a 15% tax bracket. Now this handout is an actual person. It's one of the NWM Network's clients. Now, let's take a look at the first line there. You'll see that the balance after 1 year was $102,037.74. The RMD schedule for that year was $3,773.58. Out of that RMD, that's what you're supposed to take out. Your tax on it was $566.04. Now notice the next column. That's the reimbursement column that we got you by putting your money inside of our IRA. We reimbursed $1,000 to this person that same year, which offset that $566 tax. Now you also had $3,207.55 of income there. That's income that you can take, spend, reinvest, whatever you want to do. What we focus on is that tax, and we can reimburse you. Now your RMDs are going to get bigger as you get older. So this reimbursement amount, for a while it's going to really cover it, and then it's going to slowly not cover it, but then the amount that we covered here, I mean, we almost doubled it here. This is going to last you. We're going to pay for your taxes for a long time. We're going to pay a good portion. This illustration shows 12 years. If you look down to the bottom in those total boxes, you'll see that the total tax paid over 12 years was $9,203.94. We got you, this person, reimbursements of $12,000. That's incredible. Now, this isn't the only money that the client made. This is just the guaranteed part that's going to reimburse those taxes. His money was also, it was invested in the stock market, in the S&P 500. If the S&P 500 goes up, he made money. In this particular account, if the S&P 500 goes down, he doesn't lose anything, because it's an insurance company, remember, it's a fixed index annuity. So we've taken a fixed index annuity, one of the best vehicles you can have money in, and then we've also thrown in this tax reimbursement. It's a wonderful plan. My question today for you is, Do you qualify for this? And the way to find out is to come and see us. If you flip your paper over, you can give us your information. We'll come out. It's free. There's absolutely no hassle, not going to be pushy. All we want to do is show you this information, because we found by doing talks in unions all over the country, if we just show people this illustration, it's pretty much a done deal. It just makes sense. So we're going to guarantee those taxes paid and grow your money for you and give you guarantees and put all your qualified dollars on one form, so that lessens the risk of taking the wrong or taking not enough to that accountant for him to make a mistake and you get hit with that 50% penalty. So fill that out, give it to us, and we're going to see if we can find some reimbursements for you. Now, to date, we have found over $20,000 for union members reimbursements in the last quarter. That's a fantastic number. And it grows every day as we see more and more people. This is out there, it's a real program, and we'd love to spend some time talking to you about it. So again, complete the form, hold it up really high. One of our representatives will be around to pick it up from you, and I thank you so much for your attention today.